In this lesson, we'll be discussing how to account for long-lived assets or long-term assets. These types of assets are different from the current assets that you'll find at the top of the balance sheet, such as cash, receivables, and inventory, because they're not very liquid. Instead, we intend to have these assets for a long time and use them in our business. Things like office equipment, computers, printers, a fleet of delivery trucks, heavy machinery, or even buildings. On the balance sheet, companies will usually use the account title property, plant, or equipment and add together the balances of all the accounts that fall under this classification. Take Nike, for example. Notice that immediately under total current assets begins a list of the rest of Nike's assets that aren't considered current. And if we take a look at these first items on that list, we see property, plant, and equipment net. This is the sum of all of Nike's long-lived asset accounts, or PP&E, which is another term that we often use to refer to property, plant, and equipment. Like our short-term assets, we capitalize these long-term assets by debiting an asset account and crediting something like cash or maybe a note payable. And also similar to short-term assets, we have to determine what number to include in our journal entry and ultimately what will appear on the balance sheet. Taking a look at the journal entries that we normally record when we buy something, we usually debit an expense. If we spend money, we debit an expense for some amount and we credit, let's say, cash, or maybe accounts payable if we bought the inventory, for example, on account. Now, when we do buy inventory, we capitalize it, and the same goes for PP&E, which means we debit an asset account instead of the expense. We credit cash or accounts payable, or potentially even notes payable in the case of PP&E, because it might be a longer term loan than accounts payable. And that's what we call capitalizing. When we capitalize something, we are debiting an asset instead of an expense, and it's essentially a deferred expense, meaning that we will recognize the expense slowly over time. With inventory, we recognize the expense when we sell it. With other types of assets like supplies or prepaid expenses, we recognize the expense as we use them. And with PP&E, we typically will recognize the expense as depreciation expense as we use the asset over time. And we'll use a contra asset account instead of crediting the asset directly. And that's what the journal entries that we'll be covering are going to look like. Just like inventory, you would think that the cost to capitalize PP&E would be the purchase price. But I want to challenge that instinct right now because just like inventory, the initial cost of an asset, even a long-term asset, includes the purchase price plus all expenditures necessary to get the asset ready for its intended use. When we're talking about PP&E, we call this the controlling principle. We include all costs necessary to control and use the asset. Suppose a company buys a machine with an invoice price of $100,000. It pays $4,000 to have the machine shipped to the factory, $6,000 to have it installed, and $2,000 to run test batches before production starts. Is that a $100,000 machine or is it a $112,000 machine? Well, under GAAP, it's a $112,000 machine because of the controlling principle. If you think about it, the machine sitting on a loading dock in another state can't produce anything. The freight, the installation, the testing, none of those are optional. They're all part of what it costs to have a working machine that we have control of. So they're all capitalized, meaning they're recorded as part of the asset's cost on the balance sheet instead of being expensed immediately. Now, let's make this concrete for the two most common types of PP&E. For equipment, we capitalize the invoice price, plus sales taxes, freight in, installation, and assembly, and any testing or trial runs needed to make sure that the asset is operational. Even legal fees to establish title get capitalized. For land and buildings, we capitalize the purchase price, closing costs like attorney and recording fees, real estate costs, and any property taxes that the buyer agrees to pay. But here's one less obvious fact that you need to remember about land specifically. If the land has an old building on it that needs to be torn down before we use it, the demolition cost minus anything we recover from selling the salvaged materials is capitalized as part of the cost of the land. This is because clearing that land is necessary to get it ready for its intended use. Another important distinction about land. Land itself is never depreciated, meaning we never record the cost of the land and purchasing it as an expense on our income statement. This is because the land isn't something that wears out. It's more like an investment in that respect. We'll only recognize income statement effects, gains or losses, if we sell the land for more or less than what we purchased it for, usually more. But land improvements, things like parking lots, fences, and outdoor lighting, have limited lives. We record them in a separate account and depreciate them. Now, another category of long-term assets are intangibles. These are assets with no physical substance, but they can be enormously valuable. Major types are patents, copyrights, trademarks, franchises, and goodwill. At this point, I just want you to recognize these categories and have a general understanding of the types of costs that go into acquiring intangible assets. The acquisition principle is exactly the same as for equipment. When we purchase an intangible asset, we capitalize and include the purchase price plus any costs necessary to get it ready for use, most commonly legal and filing fees. Of these intangible assets, goodwill is the only unusual one. You can't buy goodwill itself like a patent. It only arises when one company buys another company and pays more than the company's assets are worth on paper. Now, why would anyone do that? Pay more than the assets are worth? Usually for things that you can't put on a balance sheet, like a trained workforce or a customer loyalty, a strong reputation. We're paying for resources that we can't individually identify, but since we paid for it, it needs to show up on the balance sheet as an asset, and we'll call it goodwill. So, how do you decide whether to capitalize or expense something in practice? Ask one question. Was this cost necessary to get the asset ready for its intended use? Freight on the new equipment? Yes, capitalize. Installation and testing? Capitalize. Demolishing an old building on land that you just bought? Capitalize to land. But routine repair and maintenance costs after the asset is up and running? No, that's just a cost of using the asset. So it's expensed immediately. Training employees to operate the new machine? Also expensed. GAAP treats that as a cost of the workforce, not the machine. And let me tell you why this matters so much. Capitalizing a cost spreads it over many years. We'll call it an asset now and slowly recognize the cost over time. Expensing it hits income immediately. That difference is exactly what WorldCom exploited in one of the biggest frauds in history. They capitalized billions of dollars of operating expenses and ordinary costs to make income look stronger than it was. When analysts see capitalized costs growing faster than the business, they start asking hard questions. To summarize, an asset's initial cost is the purchase price plus everything necessary to get it ready for its intended use. Land is never recognized as an expense, while land improvements are. Purchased intangibles are capitalized at purchase price plus legal and filing fees, and goodwill only arises from a business acquisition. And the capitalized versus expense decision affects reported income, which is why analysts, auditors, and regulators watch it closely.